Hello and welcome to CNBC TV18's Mumbai newsroom. I'm Sumaira Abidi and you're watching Mutual Fund Corner. Joining in today, we have Prableen Bajpai, founder of FinFix Research and Analytics, and she's going to tell us whether or not it's worth your while to consider a passive strategy with your small cap investments. Also, in just a little bit, we'll connect with Saloni Sangvi, who's the founder at My Wealth Guide, to talk about, well, the very basics. How do you select an equity fund? So first up, let me invite Prableen Bajpai. Hi, Prableen. Thanks very much for joining in. So a few weeks back, we covered whether or not it was worthwhile to look at passives in the mid-cap space. And now we want to talk about small caps. But before we get into this whole active-passive debate, want to address the small cap indices as such. I mean, what is it that's there on offer for investors?
Good afternoon, Sumaira. Absolutely. If you look at the overall market capitalization in India, large caps and mid caps are quite tightly defined by SEBI because it's only a 100 stock portfolio that you can have. And here it is like a maximum of 150, the mid cap space. When it comes to small caps, it's like from the 251st company and the December, document, which was released by AMFI, showed that small caps actually go up to 5,100 company. That's all, whatever is listed. So it's almost a 5,000, stocks out there which are actually classified as small caps. And out of these, of course, different indices are constructed. Currently, we have 4 different small cap indices in India. Out of it, Sumaira, 2 of them are available to investors from investing point of view. So I'll discuss those 2. The first one is the Nifty Small Cap 250 Index. So now, like the name is suggesting, it's a composition of 250 stocks. So broadly, out of the Nifty 500, you take out the top 100 for large caps, you take out the next 150 for mid caps. So whatever remains is the 250 stocks portfolio that is there in this index. And given that, it's a huge number of stocks, the allocation to the top 10 stocks is not high. It's around 11 to 12%. It's a free float market cap based model that is followed for creation of the index. And the top sectors here are financial services, followed by capital goods, information technology, healthcare, and chemicals. And currently, there are 2 funds which are already available here. One is the Nippon India Small Cap 250 Index, and the other one is from Motilal. And HDFC has also applied for a passive index fund here. It would be tracking this particular index, and that's pending for approval. Next index, which is available to investors, is the Nifty Small Cap 50 Index. So this is a subset of the earlier index that we've discussed. And this is based on the daily turnover from the top 100 companies which are there in the 250 index. Again, it's a free float market cap model, and the number of constituents is 50. And given that the number is lesser, the allocation to the top 10 stocks goes higher as about 35 to 36%. Companies like IDFC Limited, Multi-Commodity Exchange, then KPIT Technologies are part of these indices. And here we have 2 schemes, one by Aditya Birla and the other one by Axis, which are tracking this index.
Okay. Prableen, small caps have been all the rage, right? In the recent past, what has been the movement of, say, small cap indices when you compare it to, say, the Nifty?
So the comparison is quite interesting, Sumaira, because there are years. So I've taken it from 2016. If we look at 2016, the returns for, in a positive market scenario, sometimes the returns are as high as 10 times of what Nifty had given in 2016. And 2017, the returns by the small cap index were actually more than double of Nifty. But whenever there is a fall, let's say Nifty is holding on in 2018, but what happened to the small cap index is like, by a 26% sort of a fall, which was there. Same goes for 2019, it was down. And even in 2020, what we're seeing is Nifty is down by, let's say, about 11% year to date. And we've already seen close to 20% fall in the Nifty Small Cap 250 Index. So the volatility factor is way higher, Sumaira, but it also provides, it says that there is immense opportunity for investors probably who have a high risk appetite, because when there is a bull run and things are in the positive direction, definitely small caps can be, it can be a good area to be invested in. but they do not move in the same direction. So correlation is not always positive. It is negative as well. So it's, on a year-to-year basis, it differs.
Okay, the big thing why people want to look at active funds for small caps is that, you want to give your, the fund manager's skill is on full display, right? Because this is where you really need to pick and choose. So can you give us a sense of, how the current active small cap funds are structured in India?
So by the SEBI definition, any active small cap fund in India has to invest 65% of its assets in small caps. And I think, Sumaira, this is the biggest difference which creates and how these active small cap funds are actually different from the passive strategies. Because here, the minimum requirement is 65%, and the remaining part can actually go to mid caps or large caps as well. Part of it is because to maintain liquidity, to honor any sort of redemptions which are there. And of course, sometimes there are not enough opportunities in the small cap segment, so they can move across the market cap in that 35%. If you look at the average holdings, so about 74 to 75% is actually invested in the small caps. And the allocation varies, right from 65% till about 88%, the small cap allocations are there in these active funds. So within the active fund strategy, it's again a very heterogeneous mix. The return profile has been very different. The way they are structured is very different. There are funds, active funds, which have a large cap exposure right from 0% going as high as 22%. So within these, the strategies, it's like based on what the fund manager is looking at and what their particular fund house strategy is. And that is why they're very different from one another, all of them.
Okay. The other thing is that the returns are so varied, right? I mean, there will be funds which are really good performers, and then there'll be the duds, right? So is it better to, maybe have a not so good active small cap fund, or, just opt for passive? I mean, is a passive strategy even a consideration in this space?
Sumaira, I think there are two parts to this. Number one, that, probably if we go back 5-7 years and if we would be discussing should one invest in a large cap fund or a large cap index fund or a large cap active fund, maybe our answer would be different. Today, I think we all say that, okay, passive strategy is better. So I think within small caps, we are still in that time period where the transition is yet to happen. Two things which I particularly feel are important is that currently the small cap space, as per SEBI definition, is it's like too vast. And in the times to come, there may be a regulation which may come in, which may define the segment and make it more compact. And West may be actually put up as micro caps, because we do have micro cap ETFs in the US. So that is something I think can happen in the times to come. And that would, I think, make the case for passives stronger. Currently, if we see the active versus passive performance, Sumaira, in times when the markets are doing great, during a bull run, the number of active funds outperforming the index are lesser. But as soon as the market starts to fall, the number of active funds outperforming the index is higher, because active funds have a choice to hold cash. They have the choice to move into large caps. They have the choice to do other things which an index fund cannot. So an index fund currently is a more, let's say, volatile, can be one word to define them, because they do not have that, safer playing ground with them. Having said that, I think with a 7 to 10 year horizon, maybe an active fund is a better choice. But I think if you're looking at a 20 plus year strategy, and I think in times to come, even passives, the scope to generate alpha would dry up. And then I feel a passive strategy can be better.
Okay. But, naturally, this is not for everyone, right? I mean, small cap investing itself is not for every kind of, investor who's out there. So what is the alternative?
So small caps has to be for somebody who has a minimum of 7 to 8 to 10 years horizon. Firstly, that is the that has to be understood by investors, because small caps tend to give 100% sort of returns, Sumaira. And I think it's very, very crucial for investors to understand that the rise and the fall is way steeper than any other category. Secondly, I think for investors who are looking at a pure play in the small caps, a passive route can be taken. For somebody who's looking for partial passive exposure, maybe a multi-cap strategy can also be seen, though it is a newer segment, but it'll have that compulsory or 25% allocation to small caps. So maybe that can be picked by somebody who's looking for some exposure to small caps, but not a very huge exposure to small caps. And till then, I think the active small cap funds are doing well, though investors have to be wary about the huge difference in the returns that even these funds are giving. So I think the choice must be done after decent research. And I think a staggered and a systematic approach is better for this space overall.
Fair enough. Prableen, thanks very much for joining in to talk about whether or not small caps, whether a passive option in this space can work or not, and what is the kind of time period it could work in, if at all. All right, we're going to take a very quick break. Up next, we'll talk about equity funds, and more importantly, how do you make this selection in an ever-growing universe? Saloni Sanghvi, founder of My Wealth Guide, will join us next. Stay tuned. Hi, welcome back. You're watching MF Corner. Well, investing in mutual funds, should be relatively easier than, say, stock picking. But, even the mutual fund universe continues to grow. At last count, I think we had close to 500 equity funds. How do you make the selection? How do you narrow it down to those 5, 8, 10 funds that you need in your portfolio? Saloni Sanghvi, founder at My Wealth Guide, joins in to talk about exactly this, which is the selection process. Saloni, thanks very much for joining in. How would someone like you, what are the steps that you would sort of follow to narrow down the funds from this big universe?
Hi, Sumaira. Thank you so much for having me on your show. I think this is a very apt topic given all the recent volatility in the market, and it's kind of good to get back to basics. As you mentioned that there are over 500 equity funds, so, it can be very confusing as to where to start and how to invest. So to make this easier, I recommend using a 5-step process to pick relevant funds to build your portfolio. step one is basically decide your risk-taking ability. It is important to understand and invest based on the amount of risk that one is comfortable taking. More risk means sleepless nights, and less risk means that the person might not be able to meet their goals. And of course, risk appetite changes over time and as one has more financial obligations or dependence. Once you ascertain that, step two is to decide the duration of the investment or the time to your goal. Time reduces the risk and volatility of any equity investment. And as time horizon increases, the ability to take risk also increases. Once you have these two in place, then step three is to decide the categories of funds to invest in. Now, there are 12 main categories of funds based on the style of investing and the size of the stocks that it invests in. Plus, there are plethora of thematic and sectoral funds as well. Now, you don't need to invest in every single category or theme. Size-based funds are usually diversified in terms of sectors. So, a separate sectoral fund is not required for most investors. Of course, for very aggressive investors who are okay with the volatility and can time it, they could look at it as part of their satellite portfolio. Then step one is to analyze funds within those categories to pick the ones that are best suited. Now, there are a lot of parameters to analyze funds, and we've already discussed some of them, earlier. But today, I'll just touch upon some of the few key determinants. And most data for this is easily available online, so anyone can just go online and look up data for this. First is, of course, returns. Now, the worst way to pick funds is to go online and look at funds which have the best 1 year, 3 year, or 5 year performance and choose those. Because every year, of course, the top funds will vary, and trying to chase that will only increase taxation and impact returns. I would recommend looking at a 5 year or 10 year rolling return over the entire fund history relative to the benchmark. Now, of course, past returns are no indicator of future returns, but it helps understand how a fund has performed across various market cycles. Now, along with returns, another important parameter is, of course, risk. A fund could have performed very well, but if the manager has taken much higher risk to achieve it, then that defeats the purpose. So, standard deviation can be a good measure to understand how volatile a fund is. Just an example, a fund, say, that had a return of 13%, 14%, and 15% over 3 years, has the same return compared to a fund which had maybe a 5% return in the first year, negative 4% in the next year, and 47% in the third. But both have very different levels of risk. Another parameter is also AUM, because if a fund is too small, it could be difficult for the fund to meet redemptions, and they would actually have to sell a lot of their stock to meet those redemptions then. And last is the fund manager. It's important to diversify in terms of fund manager style. So there are some fund managers that follow growth, some value, some quality, etc. But also consistency. If there are a large number of fund manager exits, then that's not a very good sign for the fund. And another important point relating to fund managers, how dependent the fund is on the manager, and whether they have processes and systems in place. Because, we have seen some funds perform quite poorly after a star fund manager left. And the last is, of course, monitor your investments on a regular basis. I don't think that one can simply buy and forget. If a fund is underperforming its peer group for an extended period of time, then one needs to probe further and evaluate if one should still hold it in their portfolio or not. So I think broadly, these 5 steps would help anyone who is looking to invest in equity and structure their portfolio.
Okay. Certainly, this is a good starting point. But, there are, like you mentioned, so many categories, right? I mean, just for equity, there are 12 categories. Now, say, based on different risk levels, according to the SEBI riskometer, all of them are high and very high risk. But for different kinds of investors, maybe for different time periods, would certain categories sort of just stand out?
Right. So obviously, personal finance, as we say, is personal, and everyone has different circumstances and needs. But broadly, we could use the amount of risk that someone's comfortable with, and the time or the holding period or time to goal to pick categories that one can look at. First off, I would only recommend investing in equity if the holding period is 5 years or more. But supposing based on the individual's asset allocation, one is looking at investing a small portion in equity for a period less than 5 years, then I would suggest looking only at index funds, large cap funds, or flexi cap funds, regardless of whether, in terms of risk, whether they're conservative, balanced, or aggressive. For someone who's conservative and has a holding period of more than 5 years, they can look at adding a mid-cap fund to their portfolio. For someone who has a more balanced risk profile and is comfortable with a little bit more risk, can look at adding a mid-cap fund if the holding period is 5 to 7 years. And a small portion can be also allocated to small cap if the holding period is greater than 7 years. And for a more aggressive investor, an international fund can be added for holdings greater than 5 years, and small cap again for holding above 7 years. So for someone who's looking at just starting, this could be a good model in terms of what categories they can look at when they're building their portfolio.
I know, Saloni, you've tried to, simplify it for us, but I can see that if somebody like me was to practically do this exercise, I can imagine spending many weekends doing it, right? So even to make a portfolio of 8, I would, at least my starting universe would be at least 20, 30 funds, right? So therefore, how much do I bring it down to? I mean, how many funds should I ideally have selected?
Usually what happens is most funds have anywhere from 20 to 50 stocks in their portfolio. So if you own too many funds in the same category, you will have a large overlap and you will end up over diversifying. So ideally, I would recommend maybe one, if you're looking at index, large or flexi cap, maybe one fund there. And then mid and small can have, 1 to 2 funds, maybe 2 funds in small, because just as Prableen mentioned, small cap is a very large universe. So even if you have 2 funds, the chances of overlap are much lower than other categories. So ideally, your entire equity portfolio in mutual funds should not have more than 3 to 6 funds.
Right, Saloni, thanks very much for joining in and for explaining this process. So with that, we're going to wind up on MF Corner for now, but do stay tuned. The team of Closing Bell joins you next.